Hello, welcome to Option Master, our e-learning course on how to trade options. My name is Asad Dasani. The first lecture is called Introduction to Options, Part 1. I'd like to wish you all a very warm welcome to Option Master. I have been working on this course for some time, and the goal of this course is to take someone who is a complete beginner and turn them into a professional options trader. So what do I mean by this? A beginner is someone who doesn't necessarily have prior knowledge or experience with options. Naturally, some of you will have some experience with options, and that's good. But I'm going to be starting from the beginning, so we'll go from the basics to understanding what options are, how they work, how to trade them, and how to make money from them. And the goal by the end of this course is to turn you into a professional options trader. By the end of this course, you will know the strategies that professional options traders use. You'll also learn how to create your own strategies and how to test them out to see how well they work. Now, many of you have also subscribed to our recommendation service, the Income Alert. I'm going to let you know now that you should please complete the first 2 lectures prior to trading our recommendations. The reason for this is that there's a lot of information in this lecture and the next one that I think is very important that you know in order to actually start trading options with our recommendations. Okay, so the first lecture is going to be more of an introduction to what options are and how they work. And the second lecture will focus on how our recommendation process works, how to actually place trades, and so on. So it's really important that you go through the first 2 lectures prior to trading our recommendations. And any questions you have about how the recommendation process works or why we're doing what we're doing, I think all of these will be answered over the course of the next 2 lectures. But certainly, do feel free to write in additional questions if you have them. So how will we be delivering the course? The primary mode of delivering the course will be voice over PowerPoint and web. So right now, this is voice over PowerPoint, where I have slides and I'm talking. We'll also be doing voice over web. So sometimes I'll be in my web browser and I'll be showing you things. For example, I may show you some option chains that you can look at. Next lecture, I'm planning to go through how to place a trade with a broker, so we'll be doing that. Mostly it'll be PowerPoint, sometimes it'll be web. And I'm going to ensure that the slides contain sort of all the information that you need. And so you can use that in order to learn how to trade. Next, you're going to need Microsoft Excel or some other similar spreadsheet software. So what we're going to be doing, particularly later on in the course, so this won't be in the beginning, but later on in the course, we'll be working with some actual option data. Okay, so we can download historical data on option prices. I'll show you where you can get that. And you can actually analyze this in Excel. And this is one very good method of creating trading strategies. Right, so you take your data into Excel and you do what's called backtesting. Right, so backtesting is when you test out a strategy on historical data to see how well it would have performed had you implemented it in the past. And we're going to learn how to do that. So that's going to come towards the end of the in the latter part of the course. But we'll be learning a lot of state-of-the-art tools to trade options and create trading strategies. So I'll be using Microsoft Excel to do this. Some of the lectures will be accompanied by Excel spreadsheets. You'll be able to download these. You don't necessarily need to have Excel if you have a Mac or if you have some other similar spreadsheet software, that should be fine. We're not going to be using too many advanced functions, so I think it should be the case that any spreadsheet software will work. But I'll be using Excel, so if you have that, then that's best. And there'll be a big emphasis on practical examples, right? So we'll be talking a little bit about sort of conceptually how options work, how we can trade them. But I'm going to focus a lot on actually looking at real data and real trading strategies and how they would perform in a live market. Okay, I think this is what's really valuable. A lot of option tutorials and courses that I've come across tend to focus a lot on kind of conceptual things, the theory, how options work, how are they priced, and so on, which is certainly important, so we'll be doing that as well. But they tend to not focus so much about how to actually trade them, right? And we're going to do that. So we're going to look at how do you actually trade them. So you may have come across certain option strategies, let's say like a straddle or a butterfly spread or something like that. And most people, I think, know what these are conceptually or how they work, but maybe they don't know how it actually does in a live market, right? How good are these strategies in practice? And that's what we'll be focusing a lot on. At the end of this course, we'll be putting out a book on options trading. This book will essentially be the course transcribed. So everything I'm saying to you now will be written down in the form of a book. It won't be exactly the same because we will make edits to polish it and so on. Obviously, when I'm talking to you, every now and then I could make a mistake and I'll correct myself. But in the book, we shouldn't be doing that. So at the end of this course, you should get a book. It will tell you, it will give you all the information that you need. Of course, you always have access to the course, and you can certainly learn everything from there as well. So now a little bit about me. As I said earlier, my name is Asad Dusani. I'm the editor at the Daily Profit Hunter. So there are two of us at the Daily Profit Hunter. There's Apurva and myself. Chances are you've come across our articles. We write for the Daily Profit Hunter. Each of us writes twice weekly, so we put out about 4 articles a week, all about trading and how to trade. And I have 2 current products, trading recommendation products that I work on. One is Income Alert, the options trading product, and the other is Alpha Trader, which is a recommendation product for currency and commodity futures. The Profit Hunter also has Swing Trader, which is authored by Apurva. Now I have some previous experience with e-learning courses. So I've worked on 3 courses so far. The first was Derivantage. This was all the way back in 2011, I think. Maybe some of you have seen this course. It's still available, and we recommend that if you're interested in learning about derivatives, then it's a good course to look at. I've also done a course called TradeMaster. This course is about technical analysis. This we put out a couple of years later after Derivantage. And the third course is Equity Master Secrets. This course was done jointly with the Equity Master research team. So this course was about value investing and how to follow Equity Master's method of finding good stocks. And this course was actually authored by Equity Master. I was in charge of delivery, so I delivered the course. And hopefully maybe some of you have been on one of these 3 courses. So welcome back. I certainly enjoyed doing all of these courses very much, and that's why I'm very much looking forward to doing this course as well. The rest of my background, so I'm a professional futures and options trader. So I focus a lot on futures trading and options trading both. I've previously worked at Deutsche Bank. There I was part of the currency derivatives team. My education, I'm currently a PhD candidate at the University of California in San Diego. I'm currently pursuing a PhD, which means that I do a lot of research. Most of my research is in finance, and particularly on derivatives and algorithmic trading. So I focus a lot on how to find patterns in historical data and use those patterns to create profitable trading strategies. And both the Income Alert and Alpha Trader are recommendation services that have come out of the research that I've done. And in this course as well, I'm going to be spelling out for you all the things that I've learned, what my research has shown me, and how you can use that to learn how to trade options. So there's a lot of really good, really interesting information in here, and I'm excited to bring it to you. Prior to being a PhD candidate, I studied at the London School of Economics and Oxford University. Alright, so that's all about me. This is going to come to the conclusion of the first video of this lecture. So just a little bit about the course format. We're going to have, each lecture will be about 1 hour long, and it'll consist of videos that are around 15 minutes long each. So there'll be 4 videos per course. And they'll be nicely broken up so that if you need to take a break in between them, that's fine. Or you can also just carry on. Okay, so that concludes the first video. Let's carry on. So now I'd like to spend a bit of time going through the structure of the course in some more detail and learning what we will be covering over the next 20 lectures. So the course is divided into 4 modules. Each of these modules will have 5 lectures, and each module has a slightly different focus and kind of goes from beginner to professional. So the first module is called The Beginner's Guide to Options, and this lecture is the first lecture of that module. The next module is Intermediate Options Trading. The third module is Advanced Income Generating Strategies, and the fourth module is the Professional Options Trader. So in the first module, we'll be covering essentially a lot of the basics of options and how they work, and we'll also be looking at option trading strategies. So, for example, how does a call spread work? How does a butterfly spread work? And so on. So even though it says beginner's guide, it's still going to cover quite a lot. By the end of the first module, you should understand what options are, how they work, and the various different type of option trades available. Right, the various different types of option strategies that are available to you. Okay, so we'll do that. And as I said, we'll also be covering how our recommendation process works. So that's very important. The second module is called Intermediate Options Trading, and at this point it's going to shift gears a little bit, and we're going to understand more about, we're going to look deeper into options. We'll be looking at how options are priced, so we'll be learning the Black-Scholes model, the binomial options pricing model. These two are very important, and we'll be learning about the option Greeks. So you've probably come across things like, the delta, the theta, the vega, and so on. So we'll be going through what all of those mean and how you can use it. And the other really important topic we'll cover in that module is implied volatility. So we'll learn how volatility affects options, right? Why is volatility important for options? And what is implied volatility? How do we use it? And so on. Okay, these are very common option concepts, and that's what we'll be focusing on in the second module. The third module is called Advanced Income Generating Strategies. In this third module, we will learn how to generate income with options. So as you know, our recommendation product is called the Income Alert, and that product does just that. It looks at, it generates income from trading options. So in this third module, we'll actually go into the strategies of how to generate income, and we'll be writing options to do that. Right? That's kind of the big difference between sort of the more simpler strategies and some of the advanced ones. Right? Many of the advanced strategies are writing options rather than buying them, and we're going to look at how to do that. And it's in this module that we'll actually learn the Income Alert trading strategy in full detail. Right? We'll see exactly how it works and kind of understand the rationale for why we do it. The fourth module is called a professional options trader. And in this last module, what we're going to do is learn how to create your own option trading strategies, how to backtest these strategies. So what this means is that we're going to be learning, for example, how to get, say, historical option data and test out a strategy that you might want to test out, right? So you may want to test out a particular income generating strategy, and I'm going to show you how to do that, right? How to do that with data in Excel. Completing that last module really puts you in the realm of a professional, because what the professionals do is that they create their own strategies and they test them out and they execute them. And the key step that they do, which a lot of retail traders don't know how to do, is to test out these strategies, is to backtest these strategies, and to actually get a really good idea of what strategies work and what strategies don't. So that module is going to cover that. And as I said, we'll be using a lot of Excel. We'll be using the most Excel in that last module, but we'll also be using it in the previous modules as well. The Beginner's Guide to Options. So the first module, as I said, is the Beginner's Guide to Options, and there are 5 lectures in this module. So I'm going to now spend a little bit of time going through each one. So hopefully you're going to get something out of the fact that I want to cover what the course is as a whole, so that you have the big picture, so that you know where we're going and where we're going to end up. So we have 5 lectures in this module. The first one is Introduction to Options Part 1. That's this lecture. And this lecture, what we're going to be doing, what we've done so far is we've kind of introduced the course, gone through in detail what the course is going to be like. And then we're going to, in the second half of this lecture, learn what an option is and how it works. Okay, so very basic stuff. But like I said, remember this course, even if you have no knowledge of options, that's fine. You can learn everything from the beginning. If you've seen options, then some of the material will not be new to you. I still suggest you go through it. You may find something, you still may learn something that you didn't know before. So we'll focus the rest of this lecture on how what exactly an option is, and some examples. In the second lecture, Introduction to Options Part 2, we'll go through in more detail the recommendation process for Income Alert, and we will go through how to place an option trade. So I'll do this over the web, where we'll go into a broker's website and show you actually how to place a trade. So as I said, for this reason, I think it's very important to go through this lecture and the next one before trading any of our recommendations, because all the information on how to trade them, what you should do, is going to be in this lecture and the next. The third lecture in this module is Option Trading Strategies Part 1. And here we're going to move away from sort of understanding how options are and what they work. So by the end of 2 lectures, you should understand what an option is, you should understand how it works, you should understand how to trade one. Okay, so you'll cover all the basics. Then we'll look at option trading strategies. So we'll look at, for example, simple strategies like buying a put or buying a call option. We'll look at slightly more involved strategies such as a covered call or a protective put. So you may have heard these terms before. If you have not, that's okay. We're going to learn everything step by step. So we'll go through some of the more basic option strategies that you can use. In lecture 4, Option Trading Strategies Part 2, we'll carry on with that and cover more complex and more interesting strategies. So for example, we'll look at butterfly spreads, we'll look at straddles, we'll look at calendar spreads, vertical spreads, and so on. So the kind of more involved and interesting option trading strategies will be covered in Part 2. And the final lecture will be about generating income from options. And I know we have a whole module on advanced income generating strategies, but in this lecture I want to kind of just cover the more intuitive part of how to generate income. So in particular, we're going to learn about how options are typically overpriced and why that's the case, and how we can generate income from options. So this fifth lecture should hopefully give you a good understanding of our trading strategy and kind of the rationale for why we do it and why it works. And by the end of this module, as you can see, you'll have already covered quite a lot. You'll know kind of most of the common option trading strategies, both simple and complex ones. You'll learn why income generation works and how to do it. And then you'll be ready to move on to the next module. So why should you trade options? Now, chances are, if you're here, you probably have some experience trading something else, maybe stocks or futures. Most people don't start out by trading options, just because they're a little more complex than trading stocks or trading futures. So typically, if you're here, you probably have some experience trading. The reasons I like options and I enjoy trading options. The first reason is the kind of payoff structure you get from an option. So when you hold an option, it's limited risk and unlimited reward. Okay. So basically, when you buy an option, you can never lose more than the premium you paid for that option, and you can make potentially unlimited profits. Of course, in practice, there's no such thing as unlimited profits, but theoretically, as long as, say, the stock price is moving in a particular direction, you can keep making profits as it moves. So that's one really attractive feature of options. The second one is that you can make money regardless of market direction. So options allow you to go long or short, right? So you can buy a call option if you think a stock is going up, or you can buy a put option if you think a stock is going down, right? So you can make money in whatever direction you think the market's going to go. In addition to that, you can also make money by trading non-directional strategies. So as we'll see in later lectures, strategies like a straddle or a butterfly spread, these are volatility strategies, meaning that they make money when the market's very volatile or not very volatile, regardless of direction. So you also have these interesting strategies. And in fact, the strategy we use at Income Alert is a non-directional strategy. Third reason to trade options is generating income. It's one of the few asset classes you can use to actually generate consistent income. And if you've seen Income Alert and kind of what how our returns look and so on, you'll see that it's very consistent. And this type of consistency is difficult to achieve in other asset classes. So there's actually really good opportunities in options to generate income and to make money and to do very interesting trading strategies. Right? You're going to see that options provide you a wealth of trading strategies that you can use, and it's very interesting. And there's a lot more possibilities in some sense to make money. The final reason to trade options is that it's fun. It's really interesting. If you're interested in how options work, you'll really enjoy trading them. It's a little more technical than trading stocks or futures, and if you like that kind of stuff, then you'll really love trading options. I certainly enjoyed trading options. I think options are very interesting. They're probably the most interesting asset class out there, and I think it's a lot of fun. And I hope you find the same. And this point about trading being fun is I think is more important than it seems at first, because it's if you're not enjoying what you're doing, then you probably won't do a good job at it. And trading is something that you don't want to do a bad job at, because if you do a bad job, you're going to lose money, and you'll be even more unhappy. So it's really important that you have an interest in markets, you have an interest in how options work. I said to you that a prerequisite that you didn't need any prior knowledge on options. And that's true, but you do need an enthusiasm for options. You do need an enthusiasm and an interest in learning how these things work. Okay, so make sure you have that, and that'll make these lectures a lot more useful for you. Now let's cover some of the option markets available. So option markets, there's a lot of them out there. So in India, we have 3 different types of options that you can trade. we have options on equity indices. The most popular one is the Nifty. And interestingly, the Nifty options are the most commonly traded index options in the world. So they have even more trading volume than options on the S&P 500 index in the US. So that's really saying something. It really gives you the scope of how well developed the Indian options market is and the money-making opportunities present within them. Then there are options on individual equities, and we also have a currency option on USD INR. So there's plenty of options to trade options, plenty of avenues to trade options, and the income alert strategy, we focus on the Nifty index, equity indices, but certainly, as you learn to trade options, you can apply this knowledge to any asset class that options are available on. Globally, options are also very big. You tend to have a little more scope on what's available, so there are equity indices, individual equities, currencies, commodities, bonds. Sort of all the various asset classes have option markets. And option markets will vary in their liquidity, so some will be very liquid, others will not. It really depends. So if you're trading index options, those tend to be the most liquid and the easiest to trade. If you're trading options on, say, individual stocks, then it'll vary by stock. So maybe the large cap stocks will be more liquid, but the smaller stocks maybe not so much. So that really you have to look at on a case-by-case basis. And then options are traded in two ways. One is exchange traded, and the other is over the counter. Exchange traded options are ones that trade on a particular exchange. So for example, if you're trading Nifty options, those trade on the National Stock Exchange. For our purposes, exchange traded options is what's going to matter. That's what's available to retail traders, and that's what tends to be liquid. The other thing you also have is over-the-counter options. Over-the-counter options are options contracts between two parties without going through an exchange. This tends to be common only among very large counterparties. So typically large companies might trade options with investment banks and so on. Again, we're not going to be looking at this very much, but I just want to let you know that it exists. So there are options out there that are not on the exchange that are traded, but we may not necessarily see them. For our purposes, we'll be focusing on exchange-traded options. So these are the options that trade on the NSE, or there's options on the BSE, and the options that are available for you to trade. Now let's go on to understand what exactly an option is. So here is the definition of an option. An option is a derivative contract which gives the holder the right, but not the obligation, to buy or sell an underlying asset at the strike price on or before the expiry date. So what does this mean exactly? First, an option is a derivative contract. A derivative means that the option's value is derived from some other underlying asset. Suppose you're trading Nifty options. That Nifty option's value is derived from the underlying asset, which is the Nifty index. So that's what we mean by a derivative. Now the option holder has the right but not the obligation, okay, which means that if you own an option, you have a choice to either use it or not use it. And the choice is to either buy or sell some underlying asset at a particular price called a strike price on or before the expiry date. Okay, so if you have this option, you can choose to use it. If you use it, you're going to buy or sell some asset at some price, and you must use it before the expiry date. Or you have the option not to use it at all. So there are two types of options. There are call options and put options. A call option gives the holder the right to buy, while a put option gives the holder the right to sell. So suppose you have a call option. It means that you have the right but not the obligation to buy a particular underlying asset at a strike price on or before the expiry date. If you have a put option, it means you have the right but not the obligation to sell some underlying asset at a strike price before the expiry date. Now, because you have this choice as an option holder, you essentially face limited risk and unlimited reward. So what this means is that when you buy an option, okay, you pay a premium to do so, and then you can either use that option to buy or sell that underlying asset, or you can decide not to use it. So if it's not in your favor to use it, you won't use it and you just lose the money that you paid for the option. And when it is in your favor, you use it and you'll make some money from using it. So in this sense, option holders face limited risk and unlimited reward. So we're going to look at an example and we'll see this a little bit more clearly. Okay, so here we have an example of a call option. Suppose we have a stock that trades at a price of 100 and a 1 month call option with a strike price of 102 trades at a price of 1. Alright, so what we're saying is the stock price S is equal to 100. So I'm going to go through each individual row here. Stock price S is 100. The strike price K is 102. And the option is a call option. So what this means is that there is an option that gives you the right to buy this stock at a price of 102 on or before the expiry date. So let's think about exactly when would you use this option. So you have the right to buy it at a price of 102. You have a right to buy the stock at 102 whenever you own this option. Now, if the stock was trading below 102, you would have no need to use this option, right? Why would you buy something at 102 when it's trading for 100 in the market? Now, if the stock price ends up above 102, then the option becomes valuable, right? Then you think, well, the stock price is 105, but I can buy it for 102, so I'll use the option. Okay? So the option price C is equal to 1. Okay, so this option has a price as well, just like the stock. It trades at a price of 1. And the time to expiry in years is 1 over 12. Alright, so this is a 1 month option, right? So the time to expiry is 1 over 12. So typically whenever you see option expiries, they're always typically quoted in years, even though most options trade on the monthly cycle. So we'll see the time to expire as being 1 month means 1 over 12 years. Alright, so suppose we have this particular option, this particular call option. Let's go ahead and see how this works. Okay, so there are a few possibilities as to what will happen when the option expires. Alright, so now we're going to assume that you've bought this option and you're going to hold it until it expires. Okay, and when it's expiring, there's going to be a couple of different possibilities. So suppose at expiry the stock price finishes above 102. Okay, so remember, you have this option to buy the stock at a price of 102. Alright, and you can decide to use that option, or you can decide not to buy anything. Now if the stock price finishes at above 102, suppose it finishes at 105, would you use the option or would you not? Well, if the stock price is 105, but I have the right to buy it at 102, then I should use it, because I'm able to buy it at a lower price than what it's trading at. And when this occurs, the option ends up finishing with a positive value, and the value is equal to the difference between the final stock price and 102. So again, suppose it's worth 105. Suppose the stock is worth 105 at the end. Effectively, you're making a profit of 3, right? Because you can buy the stock for 102 and it trades for 105. So imagine you exercise the option, you bought the stock for 102 and then immediately sold it at the market price of 105. Then you'd end up with a profit of 3. So when we say the option is exercised, it means that we decide to use the option, right? We decide to use the call option to buy the stock at the strike price of 102. Now, there's an alternative scenario where the stock price finishes at or below 102. So let's think about what would happen then. Suppose the stock price ends up staying at 100. Right, so in our example, the stock price initially is 100, and suppose over the course of a month it ends up back at 100. Then what would you do? Well, you would not exercise the option. Right, why would you buy something for 102 if you can buy it for 100 in the market? Right, so if the stock is trading at 100, it's not worth it for you to buy it at a price of 102. So in that case, what happens? The option is not exercised. So remember, when you have an option, you have the right but not the obligation to buy at 102, which means you can choose whether you want to buy it at 102 or not. And if the stock price is below 102, you're going to choose not to buy it. And then the option expires worthless. Okay? And you still lose money because you paid for the option. Right? Remember we said the option cost 1. And you'll lose that 1 that you paid. But that's about it. You won't lose anything else. Okay. So now I'd like to just look at this table here, which will show you exactly how much money you're going to make from trading this option, from holding this option, depending on what the final stock price is. So let's remember, the option cost us 1, and the strike price is 102. Okay? So, let's start in the first row. Suppose the final stock price is 98. Okay? So we have an option to buy at 102. Are we going to use the option? No. Right? So the option expires worthless. So the call option value is 0 when the final stock price is 98. And because we paid 1 to buy this option, our net profit is -1. Right? So we lose 1 from our trade. Now suppose this final stock price is 99. What happens then? Well, again, if the final stock price is 99, the call option is going to expire worthless. You're not going to buy a stock for 102 if it's trading in the market at 99. So again, the call option has a value of 0, and your net profit is -1 because you paid 1 for the option. So by the same logic, if the final stock price is 100, the option is worth 0, and your loss is -1. Your net profit is -1. If the option is worth 101, again the call option expires worthless. Your net profit is -1. Now, if the stock finishes at 102, remember in this case, we have the option to buy at 102. The call option still expires worthless because it's the same price as what it's trading at in the market. So even if you use the option, you wouldn't lose anything, but you wouldn't gain anything either. So again, at 102, your net profit is going to be -1. So now let's carry on and see what happens if the stock price finishes higher. So suppose now the stock price finishes at 103. Now the option is going to be worth something, right? Because your strike price is 102, essentially you can buy it at 102 and sell it for 103 in the market. So the call option is going to be worth 1, right? The difference between the stock price and the strike price. So the call option is worth 1, but because we also paid 1 for the option, our net profit will be 0. Now suppose the stock price is 104. Again, the call option will be worth the difference between the final stock price and the strike price. So the call option is worth 2. And our net profit is going to be 2 minus what we paid for the option. So our net profit will be 1. Moving on to when the stock price finishes at 105. Here, the call option will be worth 3. And our net profit will be 3 minus 1, which will be 2. And then the same for 106 and 107. The options are worth 4 and 5, and the net profit becomes 3 and 4. Okay, so now we've seen what is the call option worth in this variety of scenarios. And hopefully you've seen the pattern of how this works. Okay, so let's start looking at the top half of this table. Now, whenever the stock price finishes at 102 or below, your net profit is always -1. The call off always expires worthless, and you always make a net profit equal to minus what the premium you paid. And hopefully you should see that no matter where the stock price finishes, even if the stock price falls very low, so if the stock price fell to 97, 96, 95, however low it falls, the call option is always going to be worth 0. The net profit will always be -1. And this is what we mean by the limited risk nature of options, right? The most you can lose from buying this call option is 1, right? So the worst scenario is that your net profit is -1. It's never going to be lower than that. All right, so that's what we mean by options having limited risk. Now, on the other hand, as the stock price is going up, you're making money every time the stock price goes up. So the higher the stock price goes, the higher the net profit is, right? It just increases 1-to-1 with the stock price. So here we can see that the reward is theoretically unlimited, right? If the stock price finished at 108, you'd make more money. If you finish 109, you'd make even more money. If you finish at 150, you'd make a huge amount of money, right? Of course, there's no such thing as truly unlimited, because there's a limit to how high the stock price can go. But in the sense that, it can, the profit of the option is only limited to what the stock price can do, right? As high as the stock price can go, you can make that much money from the call option. Okay, so hopefully now you understand what a call option is, and you understand how a call option works, and you understand why people would like to hold this why people might like to do this kind of trade, right? Because here's a trade that makes money when the stock price goes up, but it's limited risk when the stock price goes down, right? You only lose the premium you paid. So that's what makes options very attractive. It's also what makes options quite different to other asset classes, right? There's no other asset classes that have this kind of asymmetric payoff nature, right? Except for options. Okay, now let's move on to talking about a put option. So now let's go through an example of a put option. And this example will look similar to the call option example we just looked at. So this time, suppose we have a stock, again, that trades at a price of 100, and we have a 1-month put option. So that means the option expires in 1 month, with a strike price of 99, and it trades at a price of 2. Okay, so this option is a strike price of 99, and the price of this option is 2. So let's go through this table. So we have the current stock price, S, is equal to 100. We have the strike price, K, is equal to 99. And we have the option type is a put option. So what this means is that this option gives us the right, but not the obligation, to sell this stock at a price of 99 within the next 1 month. The option price P is equal to 2, which means that the premium, or the amount of money we are paying for this option, is 2, and the time to expiry in years is 1/12, right, which is just 1 month. So as you can see, we have a fairly similar setup to the call option, but it's going to work a little bit differently, because in the case of the call option, that gave us the right to buy. The put option is going to give us the right to sell. Okay, now let's go through how exactly this put option works. So just a reminder as to how the call option worked. In the call option, we would exercise the option if the final stock price was above the strike, right? So in our example, the strike was 102. We would exercise and suppose the final stock price finished at 105. Then it would make sense to exercise the option, right? Because we can buy it cheaper than what we can buy it at in the market. With the put option, is going to be the opposite. We're actually going to exercise the put option when the stock price is below the strike price, and we won't exercise it if the stock price is above the strike price. Okay, so let's think about why this is the case. Suppose the final stock price finishes below 99. Suppose it finishes at 95. Okay? Should we exercise the put option or should we not? Well, if the stock price is at 95, but we have the option to sell the stock in 99, then that's valuable to us, right? Because we can sell it at 99, and then we can immediately buy it back in the market at 95, whatever the current stock price is, and we'd make a profit of 4. Okay, so the put option is going to be valuable when the stock price finishes below the strike price. Okay, and the more lower the stock price finishes, the more valuable the put option becomes. Now instead, suppose the stock price finishes at 99 or above 99. Okay, so let's say the stock price finishes at 102. Now, would it make sense for us to use the option in this scenario? Well, suppose the stock price is 102 and we have the option to sell at 99. Would we use it? No, we would not. Why would we sell for 99 when the current price is 102? If we can sell it in the market at 102, there's no need for us to sell it at a lower price. Okay? So as you can see, the put option is going to lose value, or it'll expire worthless, if the stock price finishes above 99, or at 99 or above. Okay? So as you can see, it sort of works in the opposite way to the call option, right? It makes money when the stock price goes down, and loses money when the stock price goes up. So in that sense, it's the opposite of the call. But it shares one feature of the call option in that it's a limited risk trade. Okay, and we'll see this on the next slide. But again, if the option expires worthless, you only lose the premium that you paid for the option. Okay, so here we have a table, and just like we did for the call option, we'll go through the various possible scenarios for the put option to see what it's worth depending on where the final stock price finishes. Okay, so let's suppose the stock price finishes at 93. Okay, then remember our put option gave us the right to sell at a price of 99. So what is the option worth at the end of that? Well, suppose we can sell at 99, but the final stock price is 93. So what we can do is we could sell it at 99 and then buy it back at 93, and we'll make a profit of 6. Right? So the put option is going to be worth 6 in this scenario. So as long as the final stock price is below 99, the put option is just going to be equal, the value of the put option will just be equal to 99 minus the final stock price. Right? So 99 minus 93 means the put option is worth 6. Now remember, we said that the price of this put option was 2, right? That was the premium for this put option. So our net profit in this case is going to be 6 minus 2, which is equal to 4. Right? So if the final stock price finishes at 93, we make a net profit of 4. How about if the final stock price is 94? So this time, again, we will exercise the option, right? Because we can sell it at 99, and then we could buy it back in the market at 94. So the value of the put option is 5 at expiry, right? The difference between 99 and the final stock price. Our net profit is going to be 5 minus the premium we paid, and that's equal to 3. So the same logic will work for when the final stock price is 95 or 96. The put option value is just going to be 99 minus the final stock price, and the net profit will just be the put option value minus the premium of 2. So let's now look at the case where the final stock price is 97. So in this case, the put option expires with a value of 2, right? 99 minus 97. And this is exactly equal to the premium that we paid. Right, so our net profit becomes 0. Now suppose the final stock price is 98. In this case, the put option ends up with a value of 1, 99 minus 98. But since we paid 2 for the option, we're still going to have a negative net profit. All right, we're going to have a net profit of minus 1. Right, because we bought the option for 2, and it's worth 1 at the end. So we'll lose 1. In the case where the final stock price is equal to 99, equal to the strike price, the put option is now worth 0, right, because there's no point in exercising it. And our net profit is going to be the premium that we lost, right? So the net profit is minus 2. Suppose now the final stock price is 100. And in this scenario, we don't exercise the put option, right? The put option expires worthless, so the put option is worth 0. And our net profit is going to be 0 minus the premium that we paid. Our net profit is minus 2. Now, if the stock price finishes at 101 or 102, in both of those cases, the put option expires with the value of 0, and the net profit is just 0 minus the premium we paid, so that's minus 2. So hopefully here you can see the same pattern that you saw with the call option, right? So as the stock price is going up, our net profit is always minus 2, right? So when the stock price is 99 or higher, the put option is always going to be worth 0. Our net profit will always be worth minus 2. So in this, again, you can see the fact that it's limited risk, right? No matter how high the stock price goes, if it goes to 103, 105, 110, the put option is always worth 0, and the net profit is always minus 2. But the potential rewards keep going up as the stock price falls, right? So if the stock price is 93, we're making a net profit of 4. If it was 91, we'd be making a net profit of 5, right? So the more the stock price falls, the greater our net profit becomes. Now there is one sense in which the put option is limited, whereas the call option is not. You are limited from the perspective that the stock price cannot fall to below 0. So the maximum you can make is if the stock fell to 0. It's just a technical thing because that doesn't actually happen in practice. But you can see the idea that the more the stock price falls, the greater the net profit from holding the put option. Alright, so now hopefully you have a good idea of how a put option works and also how a call option works. Alright, we've kind of seen two simple examples of a call option and a put option. And it's really important that you understand how this works and understand why options are limited risk, unlimited reward, right? So the risk is always just the premium that you paid, and the potential reward is just depends on how much the stock price moves. So that brings us to the conclusion of the first lecture. So just to recap what we've done this time. So we spent the first half of the course looking at the course outline. So we looked at the different lectures, the different modules, what we were going to be covering, what we were going to be learning. And again, one of the key things that I want to stress from this is that it's very important to go through the first 2 lectures prior to trading our recommendations. So you're almost now done with the first one, and then once you go through the second one, you can start trading from our recommendations. And you'll have ample time to do that because there'll be a time lag between when the recommendations start. In the second half of the course, we discussed the basic mechanics of a call and a put option. So what is an option, how does it work, and we looked at some actual examples and hypothetical examples to see what would our profit and loss be depending on where the stock price finished. Okay, so next lecture is Introduction to Options Part 2. In this lecture, we'll be doing a few things. First, we'll be going through the recommendation process for Income Alert. Okay, so I'm going to explain how those recommendations work, what exactly each term means. Then we will look at how to actually place a trade. So I will show you an example with our broker, how we place a trade, and the different fields and what you need to do. And chances are your broker should have something very similar if you have a different one. So we'll do that, and we will also talk more about how options work, the difference between buying options and selling options, and so on. So a lot to cover, very exciting. Once again, thank you for being part of this course. I'm very glad you're here. I'm very excited to share with you this experience and this learning opportunity. So one thing I would like to recommend is that you can write in your questions or your comments. You can do so on the club forums if you have questions about anything we've covered and so on. Do write them in, and I'll be happy to answer them. And another thing as well is that this course is being recorded as we go. So if there's particular things you want to learn, particular things you're interested in covering, let me know that as well, and I'll do my best to incorporate it. I really want this course to be a value to you, the listener and the reader, and your feedback and your interaction will just increase that value for you and for me as well. Okay, so that's all for this time. Thank you very much, and I'll see you on the next lecture.